Hi, so today I'm going to follow on from my previous video about the oil tanker thesis, and I'm going to go through the exact companies to invest in. And before you get too deep into this video, if you haven't seen the video on the oil tanker industry, I highly recommend going back and watching that because a lot of this video just won't make much sense without that video. So how do we invest in this industry? Let me show you. So as you know, I've already invested big time into this industry, and the way I did it was simply just buying oil tanker companies. And I plan to hold the shares in these oil tanker companies until I reach my exit strategy, and I'm going to explain in detail exactly what my exit strategy is at the end of this video. Okay, so there are about 17 decent sized oil tanker companies in the world, and I've narrowed that down to what I think are the best 8 based on their fleet makeup. Now, I wanted to find the best company from this list here as my play into the oil tanker industry. And the first thing I did was I wanted to see what each company's fleets look like. So here is a table of the size of the fleet, the makeup of the fleet, and the average age of the fleet. Oh, and a quick shout out to Mario Skaznetsny for getting a lot of this data together. So I think it is good to know how old the fleet actually is. 20 years is the life of a tanker, and an old fleet will need to be replaced soon. Therefore, the company is going to have to spend lots of money to do that. A younger fleet just won't need to spend as much money in the medium term. So Nordic American Tankers, or NAT, is the worst, with more than half of their fleet being over 15 years old. I also want to look at the makeup of the fleet. If I get to the end and I have a few companies, it might be a good idea to invest in the companies with a variety of size tankers. See, different size tankers get different rates. Sometimes the big tankers are more expensive to hire, sometimes the mid-sized tankers are more expensive. It's not too important as I think all tankers are going to benefit in the coming years, but I think it's interesting to know. The next thing I'm going to do is I'm going to look at the price to book ratios for each of these companies. And the price to book ratio is just the share price in relation to the book value of the company. I want to see under 1, as this is an initial indicator of a good bargain. What it means is that if you were to buy all the shares and then sold off all the assets and paid off the debt, well, the price to book ratio is 1, you wouldn't make any money, but you wouldn't lose any money either. You just break even. But if the price to book ratio is less than 1, well, theoretically, you could buy all the shares of the company, sell it all off, and make money. So the lower this number, the better deal we are getting. It's like buying a car. All the parts of the car are worth, say, $3,000. But if you can buy it for $1,500, well, the price to book ratio is 0.5. So since there's many companies to choose from, let's remove all the companies with a price to book ratio of 1 or higher. So can they handle their debt? And this is my biggest concern because this is, I think, is where the downside risk is. Look, I think if this entire thesis was to not play out, 2 things would have to happen simultaneously. Well, the first thing that I think would have to happen is a second wave. A second wave would severely decrease the demand for oil throughout the world, and the tankers just wouldn't have as much work. If this was to happen, I do think that the oil producers will run out of land storage again, and therefore the tankers will be hired as storage again. But if the oil producers were able to drastically reduce the amount of oil they were producing and the demand fell, well, the tanker industry would definitely suffer because there just wouldn't be that demand to move oil around or store oil. So in the short term, maybe the next 12 months, this is a likely situation. I mean, a second wave I'm not so sure about, but oil demand is clearly not going to be as strong as it was before the lockdown. And with the same amount of tankers eventually moving oil around the world, well, it's going to drive spot rates lower. So I guess it would be smart to wait and then buy when the economy is looking like it's getting back to normal, right? Well, the stock market just doesn't make rational sense in the short term. We might never see such amazingly low price to book values in the tankers that we're seeing today. So buying now when the price to book ratios are screaming a bargain, well, that's my plan. And maybe the prices go lower over the next 12 months. Well, that's not a problem either because I'm going to be very confident in buying a lot more. Because over the medium term, say 2 to 3 years, as the world gets back to normal, well, I think the spot rates are going to be strong and the tankers are going to make a lot of money. And the shareholders will eventually be rewarded. And like I've said before, it's probably going to be a bit of a wild ride. So I definitely want to make sure that they can all handle their debt because they need to be strong in all the ups and downs of the spot rate volatility. So I want to see the debt to equity well under 1 and the current ratio over 1.5. So Scorpio, STNG, although you have a very cool James Bond villain name, your debt situation is not even close to the others. So let's cut you off the list as well. Now let's talk about growth. Well, normally I'd want to see a company's really consistent historical growth, but for the tanker industry, it's a little bit different. See, the earnings of all the companies grow and decline just based off the spot rates. And as I said in the previous video, the tanker industry is just not that good of an industry. But as a value investor, I'm looking for serious value, so let's keep going. So all I'm looking for here is to make sure right now, especially since the first quarter of this year was very strong, I want to make sure they all have decent free cash flow. So I'm wanting to see free cash flow being strong as a relationship to market cap. See, free cash flow is just how much cash the business is generating after paying tax and depreciation and things like that. If a small company is making, say, $1 million in cash, then that's great. But if a big company is making only $1 million in cash, well, that's just not very good. And with International Seaways, INSW, only at 7% free cash flow to market cap, well, let's cut them out as well. So next, let's see if the companies are well managed. And what I really want to know is what the companies left on my list are planning to do with their money. I don't want to see any of them looking to expand their fleet, because if they expand their fleet, that increases competition and we don't want to see that. I like to see share buybacks, because if the company is buying shares, it means there's less shares out there for the general public, therefore my shares become far more valuable. But what I really want to see is them paying down their debt. If they are paying down their debt, well, that actually is improving the book value of the business. And if the book value improves, well, my shares become more valuable. If they pay a dividend, well, that's okay, but I'd much prefer to see debt reduction and share buybacks before a dividend. The reason I don't really want to see a dividend is because I'll probably have to pay withholding tax on that dividend, and they'll still have debt. So I'd much prefer the value of my shares to get stronger rather than them just paying me a dividend. So each of the 4 companies remaining are planning to either reduce their debt or do share buybacks. And I'm happy with both these options. I know this information because I listened to what the CEOs said when they explained their plans each quarter. So all these companies passed this stage. Now let's talk about the buy strategy. So I run each of these companies through my intrinsic value calculator. And if you want a copy of this exact same calculator that I use, well, it's free and it's in the description. The 22% rate I think is a good price. And as you can see, all 4 companies are below this buy up to price. The 30% range is just my next buy price if the prices were ever reach this level. I'll definitely want to be buying more. Oh, and I forgot to add that I've made a tutorial video on exactly how to use my intrinsic value calculator. So go back and watch that as a demo. I'll put it on the end screen as well. So these 4 oil tanker companies, DHT, Euronav, Teekay Tankers, and Diamond S Shipping, are they a good investment? Now, knowing when to exit an investment is just as important as knowing when to first buy the investment in the first place. So let's talk about the exit strategy. Even with the most stable companies that I invest in, I really need to make sure that I know when the investment has gotten way overvalued so that I know that the investment is just not worth it anymore. I always hope that I can hold an investment for decades, but sometimes valuations just go too far. I mean, let's say my Berkshire Hathaway shares, and at the moment their share price is $180. And I have valued the company with a fair price of $370 a share. Now, because the company is growing, next year I fully expect the fair value to increase, let's say to $400. But what happens if my Berkshire Hathaway shares go from $180 to say $500 in the next 6 months? Well, at $500, they have gone far past my fair value and I might as well sell. And I'll take my money and I'll put it into a new investment where I think I can pay far below fair value. Plus a 250% return in 6 months, well, it's a good deal as well. I would much prefer my Berkshire Hathaway shares to just grow with the company, which is around about 20% per annum. But the stock market is a wild place, and I just need to know when my shares have just gone too far. And this is how the market sometimes works. So I really just need to understand my exit point. Because if I understand my exit point, well, I don't have to guess anything and I don't have to worry about the global economy or anything like that. I can just be fully laser focused in on my investment. So many people just fall into the trap of holding a company too far past its fair value. Because once an investment goes too far past its fair value, well, the probability of superior market-beating returns is now unlikely. So more specifically for my tanker investment, my exit strategy is based on these 3 points. Firstly, I'm going to monitor order rates of new boats in relation to scrapping rates. If I hear all the CEOs talking about investing in new ships to expand, then I know that I have 18 months before the supply hits the water. I'll want to exit my position within, say, 12 to 18 months of this news, and this is my first exit strategy. I'll also keep an eye on spot rates for the tankers, because if the spot rates fall below $25,000 a day, then the tanker companies are not making any money. If this drags on for, say, 6 months, then I will reassess the investment, but it's not a definite exit point, but it will influence my decision. And finally, and most importantly, I'm going to wait until the companies reach fair valuation. And how do I work this out? Well, let me show you. Now, this is far from an exact science, so please make your own decisions when looking after your own investments. But what I'm planning to do is I'm going to wait until the price to book ratios of each of my companies reaches 2. So the current S&P 500 average price to book ratio is currently 2.8. So I think for an industry that's making a lot of money, I think it's fair to assume that a price to book ratio could conservatively reach, say, 2. And remember, that's still quite below the S&P average of 2.8. Now you can see that my fair value at 2 times price to book is a fair distance away from the current price. DSSI is over 500% away. But this is only assuming that the book value of the business doesn't change. But I think that as these companies make a lot of money in Q2 and for the next few years and they pay down their debt, well, this only improves its book value. So if book value was to rise, well then the fair value would also need to rise. Now let me show you the math as simple as I can. So pretend the share price is $1 and the book value is $2 per share. Well, the price to book value is then 0.5. But if book value increased to $3 and the share price was still $1, then the price to book value is now 0.33. So if the book value keeps rising to $5, well, for the price to book value to now reach 2, the share price would need to get to $10. Now that's a 10x rise from $1. And this is totally possible from our tanker stocks. As the businesses make good money, their book values will increase and therefore the share price should increase with it eventually. So the returns that I'm looking at assume book value stays the same in the future. But what if it doesn't? What if book value grows? I think there is a very solid chance that book value grows. Therefore, the return on this investment could be exceptional and far better than I have predicted. Mostly because we are buying companies that are at bargain prices compared to the money they are making. So I will exit my position when the price to book ratio hits 2. Now, of course I can't predict the future and this could all fall apart. But as a risk reward scenario, I think it is more likely that these businesses are going to perform well over the next few years. And since the prices are very low and I have big margins of safety, well, I think the downside risk is minimal. As Monish Patbrai would say, heads I win, tails I don't lose much. Now, don't take my word for it. Do your own research. At the end of the day, it's your money and it's your responsibility. Here are some other opinions on the industry that I highly recommend you take a look at so you get a more rounded view. So please search for these guys on YouTube for more information about the industry. And for me, well, I've taken out a very large position in each one of these companies. I went for 4 companies because if my thesis plays out how I wanted to, I think all of them will benefit greatly. I'm not sure exactly which one will do better than the other, so I'm taking what I think are the 4 best in the industry. I'll do an update on the industry and the companies in about a month's time when they've all reported their quarterly earnings. And that will give me more information into how the thesis is tracking. So make sure you subscribe to my channel so you're aware of that update in about a month's time, and I will see you in the next video.